Okay. Good afternoon. And welcome to our RedeConnect webinar focused on impact investment trends. We are delighted and grateful that you're able to join us this afternoon. My name is Jeremy Smith. I'm head of impact at Rede. As most of you know, Rede's had the privilege to have worked with leading sustainability and impact managers since 2014. And I head up the dedicated capability we established a few years ago to focus on the impact opportunity, an investment theme that here at Rede we see as being extremely relevant for GPs and LPs for the coming decade and likely beyond. The goal for today's session is to provide some insight into key developments within impact investment today and going forward, and focusing on trends and opportunities and challenges. In terms of the kind of order of play, we'll start with a short round of introductions, and then we'll look to explore three main topics in a bit more detail, and then conclude with some Q&A. And with regard to questions for the panelists, please feel free to input these into the Q&A section on the Zoom interface. We'll be picking those up and we'll aim to get to those as we go through or at the end. So with no further ado, I'm very grateful to be joined today by three very experienced impact investment professionals, Alison Spector, Anja Mansik, Kemper Koenig, and would now invite them to introduce themselves before we jump into our three key topics. Anja, why don't you start us off?
Sure. Hi everybody. So I'm with Mercer Alternatives. I'm based in Zurich, Switzerland. I look after our impact sustainable investments, predominantly in private equity for Europe and some of the emerging markets. Beforehand, I was with Lombard Odier, Swiss private bank, where I ran their private equity portfolio for Europe as well as the real assets portfolio. And I launched the bank's impact private markets product. I'll hand over to Alison.
Thanks, Anja. Hi, everyone. It's great to be here. I'm Alison. I'm a director of responsible investing at Nuveen, based in Brooklyn, New York. For those of you who are not familiar, Nuveen is a large investment manager wholly owned by TIAA, an institutional investor that provides financial and retirement services to over 5 million teachers, healthcare professionals, and nonprofit workers here in the US. And in that role, I lead ESG and impact efforts across our private markets and real assets platform, including our private equity impact investing strategy, and also have the privilege of advising our parent and largest client, TIAA, in its own impact efforts. And prior to coming to Nuveen, I was at the Global Impact Investing Network, or the GIN, where I led investors to try and develop new industry standards, and also helped advise institutional investors on how they might think about allocating further to impact. But it's great to be here today. Thanks.
Thanks, Alison. I'll take over. Good afternoon, good morning, everybody. My name is Kemper Koenig. I'm with LGT Capital Partners. I'm responsible for our impact, sustainability, and ESG integration efforts for our private markets assets. Largest part of those assets are in private equity. LGT Capital Partners is a alternative specialist, probably mid-sized, with about 70 billion of assets under management. And we have a very long-standing focus on sustainability. We're a family-owned business, and sort of sustainability and impact investing is in our DNA, as we say. So we've had many years of impact investment experience. Happy to share some insights today with you, and looking forward to an exciting discussion.
Thanks, Kemper. Thank you, Alison. Thank you, Anja. So let's jump in, and I'm going to invite Anja to lead off on our first topic. And as you guys know, impact investment is really a kind of theme that cuts across different geographies, different stages and asset classes, different sectors, different strategies. And I think it'd be very interesting to get a sense from initially Anya and you all on where do you see now the most exciting impact investment opportunities, and would be great to touch on your thoughts on impact themes, different stages and different geographies.
Sure, so let me maybe start. I think as you alluded to, Jeremy, impact means so many different things to so many different people. You know, it's almost like a pizza takeaway menu, right? I think we see this with our clients. You know, each one of them wants to do impact investing, but for each one of them, it means something slightly different. And this happily, in many cases, translates to a lot of interesting investment opportunities. Although at the same time, I think we still see sometimes a mismatch in terms of, you know, themes that we would like to invest in, which we think would be meaningful from an impact point of view, and the actual opportunities available. I guess, you know, a hot theme for us, which falls into that topic these days, is biodiversity. You know, super interesting from an impact perspective, still very limited credible investment opportunities, right? And I guess that's the key word there, is in a way credible. I think, you know, a lot of investors have this fiduciary duty whereby they still need to deliver returns. So I think it's our job to sift through, in a way, the myriad of opportunities and options out there. So where do we see the interesting opportunities? I think on the one hand, I think climate change as a topic obviously continues to be really at the forefront of everybody's mind. The good thing about it is, I think, you know, whether we're looking at technologies to bring us to net zero, or carbon capture, or food themes, you know, there really is so much and so many different themes which kind of contribute to the climate debate. And that climate debate has really moved on beyond just investing in renewables. So, you know, other areas we're looking at are things like energy efficiency, but also biotech is, I think, a super interesting theme, whether it's biopesticides or bioplastics, you know, recyclable packaging. So there's really a lot of opportunities there. I think it's, you know, for a lot of these, we need to be careful in terms of sometimes that maybe we're not ready for the adoption of all those technologies. It's a question of, you know, being in the right place at the right time. I think everyone is mindful of the clean tech boom and the bust which followed. You know, a lot of those funds were a little bit too early. Many of them not only didn't return capital, but actually failed to, well, you know, didn't make a profit, but also failed to return capital. So I think it's a question of picking the right technologies. Other areas I think that we continue to like and think there are a lot of opportunities in financial inclusion. Already key pre-pandemic. I think the pandemic has reinforced that financial inclusion is a way of addressing the growing social inequalities that we see. Technology is clearly playing a massive part here. It's helping to eliminate a lot of the traditional kind of transaction costs which were associated with these services. So that's something that we spend a lot of time on. I think a theme that's really sort of arisen probably in the last maybe 2 years, but again got a push last year, was gender and sort of general kind of diversity investing. Super interesting field, very nascent managers and opportunities still, a lot of different ways of looking at it. But it's also, if we think from the point of view that some of this capital is going to previously unfunded and almost forgotten sectors and managers, I think it's a good way around potentially some of the high multiples that we see generally across private markets. So actually it could be quite interesting from that point of view, as well as the impact factor of it. And really many others. From a stage perspective, I think like maybe many other investors, you know, we find it a challenge. A lot of the funds that we see are very early. You know, if we were to think of it as a pyramid, most of that pyramid base is, you know, venture funds, very often first-time teams, first-time funds. That will change. You know, the market's growing very quickly. We see a lot of interesting opportunities in the growth space. I guess the very top of the pyramid is still made up of the buyout funds in terms of very small group at the moment. We do see new buyout funds coming into the space, but I think it's the segment that is lacking in terms of opportunities still. I think there are the opportunities from an investment point of view. So it's really just a question of more managers willing to commit to an impact-led strategy in that space. I think
Annie, that's super helpful. Thank you. Alison, can I invite your views on the same?
Sure. I know this format is meant to prevent me from saying totally agree with Anya, but I do, and happy to elaborate in terms of how that plays out at TIAA and Nuveen. So Anya, you first mentioned climate investing, and we absolutely see that as a very ripe sector for investment and for impact investment. And I'll foreshadow one of my future points that I'll make later in the conversation, which is, we're really thinking critically about what it means to do impact investing in climate technologies and in energy efficiency when these are sort of becoming mainstream. And so I'll just put a pin in that for now, but would love to dive into that conversation later. At TIAA, we try to look at our impact investing strategy that a little bit sector agnostic. So we invest in resource efficiency as well as essential services for the underserved. These are technology driven, they tend to be. So you mentioned financial inclusion, mobile money. We're seeing a lot of opportunities there, but I'll focus in on that word underserved. So a lot of times when we think about impact investments, we see a lot of opportunity both on the investment performance and the impact performance side in trying to focus on sectors and activities that are considered underserved. So what does that mean when it comes to climate? We tend to focus actually on more of the demand side. So we'll look for companies that are disrupting traditional supply chains where it may not be as sort of frothy as clean tech. And we also do that where we have additional expertise from other parts of our business. So we're a very large real estate investor, for example. We work with our real estate teams to try and understand how there may be opportunities for disruption in the building material sector, for example. We've done a smart glass, dynamic glass investment. We're looking at cement, but there's a lot of opportunities in building materials, for example, to reduce the carbon emissions and resource efficiency. But you're not seeing the crazy valuations necessarily that you're seeing in other clean tech sectors. And so we would, in that sense, consider some of those sectors underserved. And likewise, of course, when we think about populations that are vulnerable to climate change, it tends to be the same populations being served by microfinance, by affordable healthcare, by remote education. And so we have a very large program investing in emerging markets as well that's focused on these basic services. And what's been really interesting is that traditional microfinance investments, that's been a very sort of long-term impact sector for many decades. We're starting to even see microfinance providers pivot towards climate-related issues. So whether that's integrating climate risk into their own business models and thinking about, for example, in India, what % of their borrowers may be subject to credit risk as we start to observe the effects of climate change, and how are they planning for that as a business? We're also seeing microfinance providers starting to offer climate-related products, whether that's weather insurance or loans that are incentivizing e-bikes. So it's really interesting. I think a lot of times investors have a tendency to separate environmental from social, and we actually think you can do both at the same time. But the key there is really to focus on what's underserved or who's underserved in the market, and how can we sort of most efficiently use our capital both to drive financial performance as well as impact. I'll pause there.
Alison, that's great. Thank you very much. Now, I think we should just, in the sort of interest of time, we will look at the, I'm going to invite Kemper now to pick up on our next topic, and is what we see a lot here at Rede is talking to LPs and actually talking to GPs, is how best should we integrate impact through the investment life cycle, and how are we meant to screen for impact, and what sort of KPIs are we supposed to talk about, and what sort of reporting are the LPs interested in? We're hearing things about, GP carry being linked to impact and these sorts of things. And Kemper, I think it would be very interesting to get your views on how you and how LGT think about what can be top quartile performance, or what kind of excites you when you see it.
Yeah, sure, Jeremy. Thanks for that. It hopefully ties into some of the comments that both Alison and Anja made, sort of in reference to a number of these topics, because they're all interlinked in some way or form, of course. But zooming in a bit on sort of best practices for integrating impact throughout the investment life cycle. Then also from sort of LP perspective, what do you expect in terms of reporting? And then to your point, Jeremy, on GP alignment, happy to make some comments as well. So maybe first, and this is going back to Anja's statements, is impact investing is very exciting and fast moving area, right? There's a lot of growth and momentum, and clearly that's driven by global mega trends, and therefore it's really coming to the fore. And I think in a way it's actually a pretty mature area of sustainable investing in its own right. At the same time, and that's probably what Anja was also alluding to, there are many managers coming to the market with new offerings, some with great intentions and pretty solid plans, but not all of them are well established or have sort of very solid long history of many funds of investing. So therefore, this whole focus, and you hear that a lot in the impact investing community, a lot of talk about standardization of what it is that we're looking at, right? I think on the one hand, we have achieved quite a lot. So we also shouldn't go back all the time, sort of defining what impact is, but it's of course the right starting point to really work with the standards that are out there from the IMP or the OPIM or like Alison used to work with the GIN. Those standards are really important to create this level playing field, that we are all at the same, using the same dictionary and the same definitions, because only from there you can actually define what it is that you're looking for in a life cycle or in reporting or in alignment. And there are a few other initiatives, of course. The SDG impact standards for private equity is an interesting development, but we don't have to expand too much on that. I guess one comment I wanted to make is also on the regulatory side. We see clearly the regulators moving now, right? And you could argue that's a bit more coming from the ESG field, but in a way they're also trying to achieve similar objectives, is really create this transparency and insights that at the end also the end investors are all looking for, is, okay, what is my investment achieving in real impact? Where am I contributing? Or maybe where am I still actually having a negative impact? So now really moving into the points that you asked me to comment on is, from there, it's important for LPs to actually understand what their investments are doing, right? And that's of course a zero-based measurement, sort of the baseline measurement. But then what impact is all about is, of course, thinking about the additionality, right? Is what have your investments from an intentional perspective, of course, actually achieved? And some of the examples that Alison was talking about probably alluded to that as well. It can be both from environmental as well as social. Is, okay, what have I actually achieved on top of what was already happening with that business or in that sector? And sort of this delta is really important for both from the reporting, but also to keep track of through the life cycle of an investment. And then and this is again to Anja's comment, is to the return question. I think most of the commercial impact investors are looking to align both impact returns with financial returns, and targeting market rate returns in its own by itself. So if you combine those, then you're also starting to see these frameworks that say, okay, the collinearity some people talk about is sort of, if the business grows and does well on selling more products or services, the impact should also grow on its KPIs or its metrics. And that's of course important to see back into reporting and to see that embedded and built into impact measurement and management frameworks. Then maybe the last point, and then I'll pause, is on the GP alignment. In a way, it might not be so different that I think most investors would like to see skin in the game, is a true commitment from investors to by the team itself or by the manager itself to really have substantial investments in their impact portfolios themselves as well. And then indeed, if there is upside potential or incentives to be shared between GPs and LPs, that should of course be again done in a methodology that makes sense. So to your point, Jeremy, for us, it makes a lot of sense to align a carried interest calculation with a hurdle for impact. But then we're at the beginning of my comments is, of course, you need to be clear and specific of how you measure your impact, right? And you don't have an IRR of impact in the same way as you have a financial IRR, but there are interesting concepts and interesting calculations out there. You can also make it very simple. You want to reach a target with a specific KPI. Have you met that target after a few years, yes or no? So that is possible, and I think it also makes a lot of sense.
Yeah, but that's super interesting. Thank you. Anja, can I invite you to comment on the same question, same topic?
Sure. Maybe starting from the back in the alignment part of it. I think, yeah, we're in total agreement with what Kemper was saying. I think it's a real challenge actually for impact is the fact that we don't yet have those standard measurements. And I think we're very wary. On the one hand, we obviously want to see impact being measured. But at the same time, if you think from a practical point of view, a lot of these teams are very small. Few people have the resources of, say, a TPG Rise. So it's a very kind of fine balance between trying to get the information you want and you need, and at the same time, actually leaving the team with time to look for new investments, execute those investments, and kind of, do the value creation in the portfolio rather than kind of just focusing on your reporting requirements. So I think it's tricky. I think, in the way that we have, I think obviously on the financial side, it's much easier to have an IRR calculation. But even within, if we think of the typical hurdle rate, there are a couple of different standards that it can, some different GPs do slightly different calculations. So hopefully in another couple of years' time, we will be able to also have one or two standards that the market can focus on for the impact measurement. I think there are some options which are emerging as the market leaders, as Kemper said, but there is still a huge plethora. We'd like, few GPs I think are still doing the carry alignment. We'd like to see more. I think it's a phenomenal signaling function in a way, in a market where there are so many opportunities and where one of our question marks is really how committed people are to impact, or whether it's just the marketing spin. Actually allocating part of the carry on those impact matrix does send that clear message that you are committed. So we are big fans of that and hoping to actually see more GPs pursue that path. I think I will pause there because I know we're tight for time.
No, that's great. Anja, thank you very much. Appreciate those insights. So I'm going to invite Alison to pick up on our next topic, which is, Alison, you have a lot of experience in the impact space over a lot of time, as does this esteemed panel, and just very interested on your views on the greatest opportunity for impact investing over the coming decade, but also the greatest threat. because as Anya touched on, there's still memories of cleantech 1.0. It feels like the macro drivers powering what's happening now feel quite different, but equally, it's something I think GPs and LPs are aware of, and I'm very interested to hear your views on, as we look forward beyond what's happening today, your view on greatest opportunity and threat.
Sure. So maybe I'll talk a little bit about the greatest threat. Actually, I'll turn it around so we can end on opportunity. And I think also the opportunity helps to address the threat. So I actually think that the greatest threat right now, and this might be a little controversial, which is fun for a panel, to impact investing, is actually that we may be continuing to set the bar too high. And that one of my concerns is that we as an impact industry are continuing to move the standard for what is considered impact investing up and up and up. And so in some regards, that's actually a great thing, right? Impact investing, in my opinion, should be the tip of the spear. It should be the most intentional, the most additional, in some regards, the deepest impact, the sort of hardest to come by. But in that sense, are we actually constraining managers too much? And now, especially with, I think what's been very interesting and special about the sort of enthusiasm around climate investing is that for the first time, I think climate investing as a version of impact investing is becoming mainstream, right? So we recently acquired one of the largest renewable energy players in Europe. I think it goes to say that renewable energy is a great thing for the world. It has a climate benefit. But what's interesting in internal conversations is we're not necessarily labeling those strategies as impact investing, right? But if we're not labeling them as impact investing, then what is impact investing? Because renewable energy, for example, has great deep impact. It's severely needed. It'll really drive the energy transition. But if that's not impact investing, then what is? And obviously, impact is in the eye of the beholder. But what I'm starting to see happen in the industry, we sort of play both sides. We are an asset owner and an asset manager. The types of questions we get from LPs or potential LPs continue just to go on and on and on, to the point where sometimes it does feel like we're a little bit constrained in what we can actually deliver. And so what I wonder is that, at what point do we sort of say, okay, the burden of proof is there, we're having great impact, and this is sort of enough. And so I'll give a couple of examples, actually moving away from the climate side. So our impact investing manager is very diverse. Diversity inclusion is a sort of a topic right now. It always has been, but it continues to be elevated. Diversity inclusion is not necessarily an intentional part of our strategy. We certainly manage for it. But we are asked by LPs quite often if we plan to increase the diversity inclusion of our team. So mind you, our team is already over 50% led by women of color. The investment committee is 50% women of color. The majority of our portfolio companies are serving people of color and underserved. But I think that, it continues to push the boundaries of sort of what we can achieve. And if we try to sort of solve all impact problems with a single strategy, we may do none of them well. And so I would put out there for the group, do we continue to sort of hamstring ourselves with more and more regulation, more reporting requirements? I mean, it definitely keeps me in a job, but I wonder if we are sort of doing this to ourselves and not applying the same standards to, for example, our traditional private equity peers. The solution or the opportunity, I do think, is actually just better measurement, better data, and better standardization or ability to compare managers over time. To do away with all these labels and reporting requirements for impact investing if you can actually just prove that you've had impact, I think ultimately that's the goal, right? And prove that you've been most efficient in delivering impact. And so how do we do that? So there's a lot of talk around standardization, and I think that's actually great. On the practice side, the operating principles for impact management that were launched by the World Bank and IFC 2 years ago, and that coupled with the new EU disclosure regulations, I think those are doing a lot to start to standardize practice and set the bar at a quite high level about what it takes to be an impact investor. On the performance metrics side, what's interesting, I've been through a lot of these exercises and efforts to try and select one key indicator or 5 key indicators that are going to be the end all be all for all impact investing. We'll be able to compare all companies and all managers. And I don't think it's going to happen. It works in the climate sector and in carbon, but in other areas that my peers on this panel were mentioning, the impact is nuanced and it's meant to be. And so what we've found to be useful is actually just to simply take the amount of impact that's been achieved and then compare that in the context of the growth of the company, as Campe noted earlier. We compare the amount of impact over time. So is it growing or is it shrinking? Is the amount of impact, let's say, low-income borrowers to total borrowers, which one is growing faster as the company, and is it growing as the company grows? And then we plot those numbers on a chart, for example. So how much impact relative to EBITDA, book value, revenues, or at the portfolio level to IRR? And you start to understand not necessarily which one is good or bad or more or less impact, but sort of how you as an investor want to allocate to impact, how that manager is efficiently managing impact. And the beauty about it is if you're using those ratios, you actually don't need a common metric. And this is not to say that common metrics are not important, but in this time where the industry continues to evolve, I do think it's important to sort of evaluate managers more on sort of how do they understand impact in relation to financial performance? How are they using that data? Are they evaluating impact with the same rigorous financial performance? Do they use the same prudence in reporting negative as well as positive outcomes? And if you ask the deal team, do they know about impact? So those are sort of the telltale questions, I would say, in thinking about a manager, and as we move hopefully to the space of greater standardization, so we could once and for all prove impact and sort of move away from so many labels. I think that will be important, but we'd love to hear what others on the panel think.
Alison, that's great, thank you. Kemper, can I invite you to give some opinion?
Yes, absolutely. And Alison, thank you for explaining that so vividly and clearly, because I think you said a lot of things very well and articulated it also very well. So as was mentioned earlier, we're not supposed to maybe agree on everything, but maybe I'll add a few thoughts or a few comments without repeating you too much. I think on your point about setting the bar too high, I actually agree indeed that sort of you can have this debate, right, about big tent or small tent and sort of high impact or low impact or impact light, some people talk about. And there you quite quickly get into indeed differences between developing markets and developed markets. In our view, and also my personal view, I think is the momentum and the move behind allocating more capital and investing more with intent is a great development in the financial industry that a lot of us that are speaking here and probably listening on this call have been working on for a very long time. So in that sense, I agree indeed with what Alison was saying. We shouldn't be too dogmatic about about all these definitions, as long as it's indeed authentic and also for real, that what investors are trying to achieve with their investments, and then has to be backed up by facts and figures, like Alison explained, also on ratios, and also not only looking at a rosy picture, but also including the negative, taking a balanced approach and including potential negative aspects. So I think that is, and a concrete example, for instance, what you see, I think indeed really mainstreaming now is one of those things in climate, indeed, is the amount of assets under management that is getting behind net zero movements is really significant. And I think a lot of us on this call again are probably involved there. And that's a great signal to the market that the train is really moving, or the train has left, and this direction of travel is really for real, right? So it's real assets that are committed to be Paris aligned, to be lowering the carbon emissions each year with 7%. And that's including probably the example that Alison mentioned. Our flagship endowment fund of 14 billion has committed to be fully Paris aligned. So we're working very hard to implement that and to reach that year over year. So I think that is actually all for real. So and then maybe on the solution side, and then I'll stop without dwelling on too long. Also interesting initiatives in our industry are things like integrated accounting, right? And that's there's a working group, Harvard Business School is leading that. The impact weighted accounting initiative is very exciting. If you have time, I recommend reading some of those papers. The whole purpose of actually combining impact accounting and financial accounting, or rephrase that, integrating the impact that companies have in their standard accounting, is probably when we've all reached our end goal, because then we don't need these panels anymore or all these standards and acronyms, because it's just fully embedded in the normal financial accounting. So also a lot of ESG practitioners stopped talking about non-financial factors, because what we're actually talking about is it has real financial impact on businesses and on our investments. So this whole area of integrating a lot of our work that we're all doing into the financial accounting and seeing that back is probably also a part of the future picture, and very exciting area to keep an eye on.
Yeah, Kemper, that's super interesting. Thank you also. Anja, I'm also going to invite you, given we're now sort of looking out to the future, and a number of these, we've had a number of questions coming in, which I think would be great to get some insight on. And one of them's coming in is actually touched on geography, which we haven't sort of picked up on so much on this call. Is, as you think about global strategies versus developed economy versus emerging market, how do you see that playing from an allocation point of view? And Anja, can I invite you to comment on that for questions?
Sure. Good. I mean, a very good question, because I think we haven't mentioned it at all. Look, I think the traditional viewpoint, and I think it ties into a little bit to Kemper's point about impact light, is that real impact can only be had in the developing markets. I think that's not really a view that we would agree with. I mean, I understand that. I think, it's very clear when you first look at it. It's much easier to see the impact, much easier to measure it. It's in a way maybe much more marketable also, right? It makes for better headlines. But I think at the end of the day, if you think of some of the themes that we're looking at as within impact today, whether it's on the climate change or the environmental investment themes that we've mentioned and we've touched on today, a lot of those opportunities are being driven out of developed markets. And I think, also secondly, there is a clear need also in developed markets, right? So it all depends on which theme you want to address through your portfolio and what are the priorities for you. But I think as an impact investor, you can, the whole world is really your potential allocation, right? So it then depends for a lot of people, it's important to have very local impact. And we see really a dedicated managers, sometimes even regional. The US, I think, is much ahead of this in terms of Europe, very localized, specialized niche offerings. But we're seeing more of that in Europe, sometimes with government involvement on the side, but not always, all the way through to global strategies for clients who wish to, I guess, have a globally diversified portfolio on the one hand from an investment perspective, but also from an impact perspective to have who have a broad understanding of impact, which is at the end of the day, I think, where we would come out as an organization as well. So yeah, I think we would not see that link necessarily between geography and impact and the amount of impact that you can have.
Great. Alison, any views on similar question?
Sure, I would agree with that. Yeah, we again, as I mentioned, we look for underserved opportunities, and you can find those anywhere. I think in the US or in developed markets, for example, affordable housing, whether that's workforce housing or for families or for seniors, this notion of place-based investing in your backyard, I think continues to be attractive to institutional investors. You can sort of point to your impact and serve local communities. I think in emerging markets, as Anya said, it's sort of more, it's always been more marketable. And certainly from both let's say a climate vulnerability perspective on both the people and the planet side, there's considerable need. And so we do take that into account. And then there's also some opportunities, interestingly, that go both ways, right? So we're invested in an energy storage, a battery company in the US that is actually targeting licensing technology in emerging markets and making energy storage affordable for emerging markets. And then you also see a lot of the interesting sort of mobile technologies from emerging markets impacting developed markets. And so, I think one question is sort of where do you feel comfortable in taking sort of investment risk and currency risk in terms of the sort of location of these companies, but also the impact can go well beyond those borders as well. So I think we can think about geography from both a sort of very narrow investment standpoint, but also sort of where do you hope that impact to ultimately lie.
Great, thank you, Alison. Well, we've got more questions, but I think we may be running out of time, unfortunately. So I'm going to take this opportunity again just to say thank you very much indeed to the panel today for your insight and experience and sharing your thoughts in such a kind of concise and dynamic way. I really appreciate it. It's really interesting what you guys are doing and how you're seeing the market. And just would like to also thank everyone who joined the session today and hope this has been helpful for your own institutions and organizations as you think about how best to engage with the impact investment opportunity and theme. Thank you very much.